topic that we're going to cover in today's video is whether we should be, as Indian residents, spending or hedging our portfolio and investing outside of the country, for example, in America, because the Indian government does offer you avenues to invest and bring your money and convert your Indian rupees to a US dollar or to another international currency. The question is the juice worth the squeeze? And is it worth all the round trips of converting and playing with these currencies? And is it going to be getting you ahead of, from a financial standpoint, over a long arc of time? Again, none of this is financial advice. Talk to your financial advisor, speak to people who advise you on your portfolio and make very prudent decisions. But this is intended to kind of like do a mathematical deep dive into seeing if the numbers work out. All right, with that said, let's jump in and let's look at the numbers. All right, so let's look at the scenario, the hypothetical scenario of you investing about $250,000 into the US markets. The current exchange rate, as you can see, is about 88.72. The Indian government imposes what is called as a withholding tax for about 20% on any investments that are leaving India. And that's 20% on $250,000, so the net investable amount available is around $200,000, and that converted into INR is about 1.7 CR. Now, since you're keeping away the $50,000 from investment, you have to calculate the opportunity cost for it, because that's something that you have to reclaim back at the time of tax filing. And let's assume that there's a 12% opportunity cost there. That's about $9,000 lost in opportunity cost. Let's assume that the rate of return in the US is about 10%. The rate of return in India, just for comparison's sake, is also 10%. Now, the forex conversion cost, which is the cost that is required to convert your currency from INR to USD, charged by these financial institutions, is typically in the range of about 0.5 to 1.5%. Now, let's assume the worst case scenario and take the 1.5%. That is about $3,000 in the upfront. Let's assume that the period of investment is about 10 years. The INR depreciation per year is typically about 3.9%. That's the data over the last 10 years. And most economists expect that the INR depreciation is going to continue, the trend is going to continue going forward. Now, there's so many reasons that define why a currency depreciates versus the US dollar, or how currencies interoperate. I don't think that is the focus of this conversation, but let's assume that is going to be the case, and let's sandbag a little bit, and let's not assume 3.9, let's assume just 3%. And if that is indeed the case, 3% depreciation over the 10-year period gets your currency from 88.72 here to 119.23. And the investment growth with a 10% rate of return over a 10-year period is $518,000. Just like you had an outbound fee of getting money out, there's also an inbound fee of getting money in, which is the same 1.5%, which on a larger sum of money is about $7,800. Which is double the amount of the outbound fee, because again the sum was half of it. Let's also bake in some kind of surprise fees or any kind of charges, which is about $500. So the net amount in USD is about $498,000. The amount in INR, if you were invested in the US, is about 5.9 CR at a 10% rate of return. The same amount if you had invested in Indian instruments, let's say in an ETF in India or in a mutual fund in India delivering 10% return, that would have been equivalent to 4.6 CR. So the big delta that you're getting in your returns over here, which is almost about 1.3 CR, is all driven by the currency depreciation, and the fact that the currency depreciation is actually getting you to a CAGR, which is almost 280 basis points. You see this, right? 12.8% in India, US versus 10% in India net CAGR. And that alpha of 2.8% is significant. It compounds year in and year out. And while it might seem it's only 2.8%, it's a pretty big number as if it continues over a longer period of time. So the amount that we have in terms of net benefits is about 1.3 CR on a $250,000 investment over a 10-year period. And see, 1.3 CR after a 10-year period is not going to be the same. There's going to be always a discount factor rate that we need to add to bring it back to the current cost. So if you were to do an apples to apples comparison, the present value of the net benefit is close to about 75 lakhs, which is a significant sum of money even today, right? So let's assume that we go to a longer horizon of about 20 years. If we go to 20 years, the benefit is about 2.8 CR in terms of present day benefit. And in terms of the benefit at the end of the period is about 9.1 CR. So just one investment over a period of 20 years is going to yield you significant value if you hedge your currencies, and if you make an investment in a currency which has traditionally been more powerful compared to the Indian rupee. Again, this is purely math. This is not financial advice, but this is something that if you have a lump sum of money to invest, the Indian government does offer you a channel to use the liberalized remittance scheme, which is the LRS scheme. And it might be a worthwhile opportunity for you to discuss with your financial advisor to see if it is the right fit for you. But summary, there's one thing that's very clear. There's certainly an arbitrage opportunity because of the currency variations between the US and India in making an investment in the US. Especially if the depreciation is in the 3% or upwards of 3% range, the savings are meaningful over a period of time. And even if India delivers a significantly higher rate of return to the extent of about 300 basis points, you might be net neutral. But this is a way for you to kind of like potentially have a part of your assets invested in deeper financial markets like the US. And also get an opportunity to participate in the upside in some of the companies that are participating in tech and in areas which India is not leading the rally. So those are things that you have to consider when you're making your investment choices. Be prudent. But if you like this video, share and subscribe, and see you on the next one. Cheers. Bye.